What's going on, everyone? I'm just taking some time to go over the Candlestick Bible. It's the weekend. This is when you're supposed to be doing work. This is a great time to go back to fundamentals and just reacclimate yourself with everything that you've learned. And sometimes you miss things, and it's good to reiterate them. Okay, so that's table of contents. I just went over the engulfing pattern. So I figured, you know what, let me start a Zoom and maybe somebody else and everyone can learn all what we're doing. So let's go down to where I was. Here I went over, see how it says shadow? That's also wicks. Different words, same meanings. Long versus short. Okay. What was it? Okay, the engulfing block. Bearish engulfing. Pretty much when price, when the second candle engulfs the previous candle. Whether it's a whole body, the body has to engulf the previous candle, not a wick. It has to be a body. So that's a bearish engulfing. Here it is in an uptrend. A good sell signal would be this occurs at the end of an uptrend. So if you're at the end of an uptrend and you see this candlestick pattern occur on a lower time frame and your higher direction tells you that the market may be reversing at this area, this would be your sell signal. This is called price action. In case nobody understood, price action is a candlestick pattern. Bullish engulfing, same thing. Body, wick, it engulfs, it beats. It's a bigger person to the previous. Pretty much just stomps on the previous candle. Okay, at the end of a downtrend, vice versa. Bullish engulfing, closed above it, out of here. Colors of the body is not important. Yeah, whatever. Don't try to trade the market using this price action setup alone. We never use one confirmation. We always want multiple confirmations, at least 3. Okay, moving on. Now we're going to slow it down. Ready? Okay. The Doji candlestick pattern. Doji is one of the most important Japanese candlestick patterns. When this candlestick forms, it tells us that the market opens and closes at the same price, which means that there is an equality and indecision between buyers and sellers. There is no one in control of the market. So this is pretty much just telling you the market is neutral. There is not enough bulls. There is not enough bears. We're at a neutral zone. Now this at the end, you know what, they're going to go into that. Let me not give away anything. It's neutral. See how it's not going up to the high, not going up to the low, right in the middle, indecisive, very neutral. It's like shifting your car into N. It's just neutral. No gas, no brakes. As you can see, the opening price is the same as the closing price. This signal means that the market didn't decide which direction will take. When this pattern occurs in an uptrend or downtrend, it indicates that the market is likely to reverse. That's another thing to do. Let's send this link out. Okay, here's an example of the Doji candlestick. So we have the bears in the market. Oh, sorry, we have the bulls in the market. They're no longer strong. Sorry about that. They're no longer strong. It's indecisive and reverses. So another way to look at this, look at all the strength. This is bull strength. They're strong. Why is it no longer white? That means we can identify that the bulls are not strong anymore. So, and the bears, it's like having a 2-on-2 or a 20-on-20, we're equally matched. So if we're equally matched, it's just a stalemate. It's a tie. They're not strong anymore. They're no longer in the market. So what can we anticipate? There might be sellers now because they're not strong no more. Where's all the momentum? This is all like 0, 20, 40, 60, 80. We're going 80 miles an hour. Then what happened? Slow down. Now we're going the other direction. That's something to think about. I want to get this invite link. There we go. Get out of here. Awesome. Get that out of here. Awesome. Awesome. All right. The chart above shows how the market changed direction after the formation of a doji candlestick. The market was trending up. That means the buyers were in control of the market.
Hi, Sean.
Hello, hello. I'm just going to mute everybody. Okay, we're just going over candlesticks. We're not doing. Wait. Keep trying. Your microphone. No, let's take that. Okay, nobody can unmute. All right. So we're going over the doji candlestick. The chart above shows how the market changed direction after the formation of a doji candlestick. As I'm going over these, it's really good to draw these in a notebook. So I have a notebook ready and just start drawing these formations. The market was trending up. That means that buyers were in control of the market. The formation of a doji candlestick indicates that buyers were unable to keep price going higher and sellers pushed prices back down to opening price. So again, we can see neutral. It closed right over here and started pushing down. This is a clear indication of that a trend reversal is likely to happen. If you get a candlestick pattern, such as an engulfing candle at the end of a trend, that's a pretty good signal. You want to look for candlestick patterns at the end of trends. This is a clear indication that trend reversal is likely to happen. Remember always that a doji indicates equality and indecision in the market. You will often find it during periods of resting after big moves of higher or lower, sorry. When it is found at the bottom or at the top of a trend, it is considered as a sign that a prior trend is losing its strength, like I just said. Top of a trend or at the end of a trend. So if you're already riding the trend, it's time to take profits. It can also be used as an entry signal if it is combined with other technical analysis. So what that means, let's say we were in on a buy and you see this candle, this is good, we're moving strong, get out. Why? Because there's no more strength anymore. If anybody has any questions, use the chat. I'll open up the chat every now and then. The Zoom chat, no need to go into WhatsApp chat. Vice versa. Okay, we're in the buy. We see this candlestick, get the hell out. We can wait for the bear. This is also a bear going down. And you can take the sell signal or let's leave it alone. Personally, I would just leave it alone. This is a good formation. I see no longer buyers are in the market. I'm not going to switch for a sell because honestly, just looking at this compared to this is a straight away. This is messing around. It settled over here and then went down some more. That's a waste of time. Any questions? Okay. Okay, we're talking about writing trend. Dragonfly doji pattern. There's different names for this. If you want to use a dragonfly, we can go with that. That's also a hammer. The Dragonfly doji is a bullish candlestick pattern which is formed when the open, high, and close are the same or about the same price. What characterizes the Dragonfly doji is the lower tail, the long lower tail that shows the resistance of buyers and their attempt to push the market up. So, closing price over here, long wick to the downside, it's a fake out. Because sellers try to push them down, the bulls said, nope. This is not a regular doji. There's no wick to the upside. The sellers tried to come in and the bulls said, no, we're stopping you right here. Okay? This is I want to be correct. This is a bullish. Yes. This illustration shows us a prefect Dragonfly doji. The long lower shadow tail wick, I'm going to keep saying wick. The long lower wick suggests that the forces of supply and demand, this right here, this should be a note. This is how the market moves, supply and demand. That's simple marketing for anything, supply and demand. Are nearing a balance and that the direction of a trend may be nearing a major turning point. See the example below that indicates a bullish reversal signal created by a Dragonfly doji. Again, you do not want to use one candlestick as your sole confirmation. Here it is in the trending market. We're going down. We can see that we have the Dragonfly doji down here. Sellers tried to hammer it down. They failed. Stuck here for a little bit. You can see another one out of here. In the chart above, the market was testing the previous support level that caused a strong rejection from this area. The formation of the Dragonfly doji with the longer wick shows us that there is a high buying pressure in this area. Fake out to the downside. That's another way of putting it. If you can identify this candlestick pattern on your chart, it will help you visually see when support and demand are located, because it wick support down here in this area. Because it's down, I can tell this is the bottom, so this would be support. When it occurs in a downtrend, it is interpreted as a bullish reversal signal. But as I always say, you can't trade a candlestick pattern alone. I already went over that with you guys. Gravestone Doji. Now, just going off this, I'm pretty sure this is just the inverted way, right? Yes, it is. Look at this one. This is the Dragonfly to the top side. Now the Gravestone would be, this is the bearish version. So you could just, yep, they're both pretty much called hammers. So you can say this would be a bearish hammer and the bull hammer. So the bull looks like Thor. That's Thor's hammer on top here. You can say this is Thor's hammer. And this looks like the thing that they use to stomp asphalt with, but just a pounder. So bearish candlestick. The Gravestone Doji is a bearish version of the Dragonfly. It is formed when the open and close are about the same as price. I hope you guys are like drawing these candlestick patterns out. So you could just draw this and say bearish, and then draw the other one and say bullish. So you understand how to differentiate them. You don't have to go to the name. Don't kill yourself going over the names. Just say, I know that this is a bear candlestick pattern, or I know this is a bear move, and I know that this is the bull doji. However you want to call it. Just make it easier on yourself. So the Gravestone Doji is a bearish version of the Dragonfly. It is formed when the open and close are about the same or about the same. Let me just check this really quick. No, nothing. We're good. Yeah, we're all good. Okay. Gravestone Doji is a bearish version of the Dragonfly. It is formed when the open and close are the same or about the same price. What differentiates the Gravestone Doji from the Dragonfly Doji is the long upper shadow. The formation of the long upper shadow is an indication that the market is testing a powerful supply or resistance area. So as we can see here, now we're going to see it in a market. Okay, so this image shows you the bear candle, the bear candlestick pattern. This pattern indicates that while buyers were able to push price well above the open, later in the day, sellers overwhelmed the market, pushing the price back down. So this just tells you, like, okay, the bulls are losing their momentum. Be mindful of that. Now, I wouldn't use candlestick patterns on the 1 minute or the 5 minute, 15 minute and up. Why I would say in that 1 minute and 5 minute? Because it's too short of a time span. It moves too rapidly, so you wouldn't be able to depend that as a confirmation. But if you have all your confirmations on the higher time frames and you come down to the 5 minute for entry and you see this, then I would say, yeah, if you have all your confirmations, at least 3, and you have this as your final one for entry, by all means, get in. Do not use a candlestick pattern by itself or one confirmation by itself to get into a trade. Later in the day, sellers overwhelm the market, pushing the price back down. This is interpreted as a sign that bulls are losing their momentum and the market is ready for a reversal. The chart above shows a Gravestone Doji at the top of an uptrend after a period of strong bullish activity. We saw them all come in, all the bulls came in and ran through. They're running it, running it, running it, running it. Sell over here, running it, X-nay, trying to get out. Okay, you got to be mindful of when you're watching your trades. Now let's say if we're over here or if we're over here. It also settled here and then gave you a little bit more pips. So you can get out anywhere above here. This is all signs to get out, because why? Look at the strength. You're not seeing whole bodies anymore. You get one more here to keep the buyers into the market, and then we settle. If you're not getting any more pips, why the hell would you stay in? That's something to be mindful about. If you're in an area like this and your trade is not moving anymore, now you're getting stuck. Don't be greedy. Just get out. Put your stop loss right below here, in profit. If you got in down here, you're in profit. Now, this is when they're going to take all their money back anyway. It's bound to happen. The formation of this candlestick pattern indicates that buyers are no longer in control of the market. For this pattern to be reliable, it must occur near a resistance level. So, at the end of a trend, at the end of a trend, or coming up to a key zone, candlestick patterns close to key zones or at the end of trends, those are confirmations. That's 2 confirmations now. If I have a candlestick pattern and I go up to my resistance or my support, if I go up to my resistance or my support, that's a confirmation. Or If it's at the end of a trend and this happens, that's a confirmation. Things like that. You want to tie things together. As a trader, you will need additional information, like I just said. I don't need to go into that. Morning star. Okay. The morning star pattern is considered as a bullish reversal pattern. So morning star, bullish reversal, that means it's a bear candlestick pattern. It often recurs at the bottom of a downtrend, and it consists of 3 candlesticks. The first candlestick is a bearish, which indicates that sellers are still in charge of the market. So this is our bear candle. The second candle is a small one, which represents that the sellers are in control, but they don't push the market much lower, and this candle can be bearish or bullish. So this one in the middle, it's a doji candle pretty much, and it can be white, black, green, red. It can be bull or bear, doesn't matter, but it has to be small than these two. The third candle is a bullish candlestick that gapped up on the open and closed above the midpoint of the body of the first day. This candlestick holds a significant trend reversal signal. So the third candle is a bullish candlestick that gapped up on the open and closed above the midpoint of the bear candle, okay, which will be the first candle. So it closed above the middle of this. All right, see how that works out? The morning star pattern shows us how buyers took control of the market from sellers when this pattern occurs at the bottom. See, all of them are at the bottom of a trend or support level. See that? Everything I'm saying. Trend or key zone. Candlestick patterns occurring at the end of a trend or key zone, approaching a key zone. That is how you look for price action. It is interpreted as a powerful trend reversal signal. Okay, here it is here. We have a bear candle. We have our doji candle. Middle. I didn't say it has to engulf it. It has to be past the middle. If it is, look what happens. We're at the bottom. This was a chef on a daily. We're at the bottom of a trend. It's ending. We can see combining all the candlesticks together that we just learned. We don't have an engulfing. Okay, so X that out. We have a doji. What do we learn about the doji? It's neutral. Then we have the bull candle that's closing above the mid zone. This is our morning star. Okay, doji candles means that where's all the strength? Look how black it is here. Where's all the strength? Right? Then time to get out. Wicks to the high, that means the sellers are still in. The buyers are not coming in. Now here, wicks to the low. Now that's different than this. Okay, close trade. See this at the end of a trend. Execute, out of here. The chart above helps us identify the morning star pattern and how it is significant when it is formed at the bottom of a downtrend. As you can see, the pattern occurred at the obvious bearish trend. Well, yes. The first candle confirmed that the seller's domination. The second one produces indecision in the market. This is the doji. Sellers, the second candle could be a doji or any other candle. But here, the doji candle indicated that sellers are struggling to push the market lower. The third bullish candle indicates that buyers took control from the sellers and the market is likely to reverse. So, to simplify all of that, first candle, bear, second candle, middle candle is a doji, indecisive, neutral candle, tells you to get out. Wait for the next one, which is your final confirmation. Am I staying in? Is it going to keep going down? No, came right back. Time for me to close my trade. Get out. This is how professional traders analyze the market based on the candlestick patterns, and this is how you will analyze financial markets if you can master the anatomy of candlestick patterns and psychology. Now the evening star pattern, same exact thing, but inverted now. Okay? The evening star pattern is considered as a bearish reversal pattern. This usually occurs at the top of an uptrend. So evening star is top of an uptrend, morning star is bottom of a downtrend. The pattern consists of 3 candlesticks. The first is a bull candle. The second candle is a small candlestick. Again, it can be bull or bear. It's a doji or any other candlestick, but it's smaller. It's always just smaller. The third candle is a large bearish candle. In general, the evening star pattern is the bearish version of the morning star. Excuse me. So we can see right here. Now anyone can say, but it didn't engulf it. It's not supposed to. It doesn't generally have to. What we're looking for is momentum. We see the bulls are in, they're losing their momentum, and now bears are coming in. This is a price action candlestick pattern. If you have bulls going up, 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 and then they start to lose, there's no reason to stay in this trade anymore. You can get out. But at the same time, this is why I wouldn't use like the 1 minute time frame, because if you look at that and you see this, yes, you can, every candle is 1 minute. You need to give yourself more chance. So I like looking at the 5 minute or the 15 minute. 15 minute preferably, because that's 15 minutes in one candle. That's a quarter of an hour. That gives you enough time to make a decision. The first part of an evening star is a bullish candle. This means that the bulls are starting to push the market higher. Right now, everything is going all right. The formation of the smaller bodies shows that the buyers are still in control, but they are not as powerful as they were. The third bearish candle indicates that the buyer's domination is over, and a possible bearish trend is reversal. And a possible bearish trend reversal is likely to happen. See another chart that illustrates how the evening star could represent a significant trend reversal. Again, so the evening star happens at the top. That's a lot of wording just to say, to break it down. But see, like I said, bulls are in, momentum, momentum, momentum. This didn't happen before. We're not at the top. You want to look for these candlesticks at the top or bottom. That's where they're most key. So if you're in the middle of something and you see like, oh, you have a hammer or something, don't psych yourself out. You want to wait for it. So let's just say this is at the top of an uptrend. This is our resistance. This candlestick, that's 3 confirmations. Now, if this were over here, is that a zone? No. Is that the high? No. So we don't care. It's not doing anything. As you can see, the market was trending up. The first candle in the pattern indicates a long move up. The second is a short candle indicating price consolidation and indecision. Okay, 3 candlesticks. In other words, the trend that created the first long bullish candlestick is losing momentum. The final candlestick gapping lower than the previous candlestick, indicating a confirmation of the reversal and the beginning of a new trend down. To simplify all that, I like doing this, zooming out, seeing the big picture, looking at your trade. You're in profit, you're not stagnant, you're in profit, and then you see it coming back down. Your stop loss should be above here, in profit. It'll take you out. Why not just come out over here? You're losing momentum anyway, so you want to get out. Okay. The hammer. The hammer candlestick is created when the open, high, and close are roughly the same price. It is also characterized by a long lower wick that indicates a bullish rejection from buyers and their intention to push the market higher. So here's our pin bar. Little to no upper wick. Okay, closing price. See how long this wick is down here? That is a hammer. This is like a sledgehammer. Okay. The hammer is a reversal candlestick pattern which occurs at the bottom of a downtrend. All of these are occurring at the end. So you want to look for these at the end. This candle forms when sellers push the market lower after the open, but they rejected the buyers, so the market closes higher than the lowest price. So you can see little to no wick to the upside, small body, big wick to the downside, hammer. So it pretty much went down and bounced right back up. Okay, we hit the floor. It's like that little game back in the day when you used to take the hammer and hit the bell and see how high it would go. They slammed it down and it went back up. As you can see, the market was trending down. The formation of the hammer or the pin bar was a significant reversal pattern. The long wick represents the high buying pressure from this point. Their bulls are strong. Sellers were trying to push the market lower. The bears are weak. But in that level, the buying power was more powerful than the selling pressure, which results in a trend reversal. Bulls win, bears lose. Simplify that. The most important to understand is the psychology behind the formation of this pattern. If you can understand how and why it was created, you will be able to predict the market direction with high accuracy. Pay attention to the low and high of the day, the low and high of your sessions. We will talk about how to straighten. Okay, I can tell you guys about that. The shooting star. The shooting formation is formed when the open, low, and close roughly the same price. This candle is characterized by a small body. You see what I mean by we should draw these candlesticks out, because look how confused you can get. We have morning star, evening star, now we have a shooting star, and then this is called a hammer. And this, yes, but the wick is longer. So the shooting formation is formed when the open, low, and close are roughly the same price. This candle is characterized by a small body. Small body, closing price, long wick. It is a bearish version of the hammer. Professional technicians say that the wick should be twice the length of the real body. See what I mean? Longer wick. So shooting star, keynote in red, put an asterisk, put a star. Right where it has to, should be twice the length, should be long. Big wick. Big wicks. That's it. It's big wicks. The illustration above shows us how a perfect shooting star with a real small body and upper long wick, when this pattern occurs as an uptrend, it indicates a bearish reversal sign. So again, this would be our wick to the high. If you have a long wick to the high, we're out. Time to get out. The psychology behind the formation of this pattern is that buyers try to push the market higher, but they got rejected by selling pressure, like I just said. So the buyers are coming in. We came up. Shoot! Whoa! Why didn't you guys close? So shadows, wicks. What are they calling this stuff? Shadows. Yeah, the shadows. I call it wicks. The best way to look at this, it's strength. It's all strength. When the candlestick forms near a resistance level, again, we're going back to key zones, it should be taken as a high probability setup. So we have our shooting star, bull, 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 bull. What happened? What the hell is going on? Get out, close, if you're in for the buy, or we're waiting for it to come to our resistance. We get our rejection to our zone. Now we can get in. Price settled down here. This is all entry right here, out of here. The chart above shows a nice shooting star at the end of an uptrend. The formation of this pattern indicates the end of an uptrend move and the beginning of a new downtrend. The candlestick pattern can be used with support and resistance, see, supply and demand areas, and with technical indicators. The shooting star is very easy to identify and is very profitable. It is one of the most powerful, okay, I wouldn't say all that, but candlestick patterns are the main basis of price action. So you don't enter a trade without any price action. Simple as that. And you always want at least 3 confirmations. In the next chapters, I will talk about, okay, yeah, we'll do that. The Harami pattern, the inside bar. Okay. So the pregnant pattern is considered as a reversal and continuation pattern. It consists of 2 candlesticks. The first candle is the large candle, and it's called the mother candle, followed by a smaller candle, which is called the baby. For the Harami pattern to be valid, the second candle should close outside the previous one. The candlestick is considered as a bearish reversal signal when it occurs at the top of an uptrend, and is a bullish signal when it occurs at the bottom of a downtrend. From reading that, I can see people getting confused with this and an engulfing candle because it sounds the same. I'm not going to scroll down yet. The first candle is a large candle and the second one is a small candle. That sounds like an engulfing candle. So now we're going to go take a look at it. See that? The engulfing candle, the pattern is flipped. 1 second. All right, sorry about that. So again, the engulfing pattern, it's reversed. You want this candle on this side and this candle on this side. Okay, so that's the engulfing pattern. So for the Harami, Harami means pregnant. So for the pregnant lady candle, you have a mother candle and a smaller candle. Mom had a baby. Okay. This candlestick is considered a bearish reversal signal when it occurs at the top of an uptrend, and it is when it occurs at the top of an uptrend, and it is a bullish signal when it occurs at the bottom of a downtrend. Okay. So this is the bullish inside bar. Harami pattern, bearish inside bar. The difference? You have a bull and a bear and a bull. Questions? Okay. As you see, the smaller body is totally covered by the previous mother candle. Don't bother yourself with colors. The most important is that the smaller body closes inside the first bigger candle, and significantly too. So buyers and sellers don't know what to do, and there is no one in control of the market. When this candlestick pattern happens during an uptrend or a downtrend, it is interpreted as a continuation pattern, which gives a good opportunity to join a trend. So this is not reversal, this is joining. Okay, don't need that. When this candlestick happens during an uptrend, okay, and if it is occurred at the top of an uptrend or the bottom of a downtrend, it is considered as a trend reversal signal. So top or bottom of a trend, reversing. Now we're switching sides. If we're in the middle of a trend, you can join it. So join means then you can continue the trend. You can continue taking trades in that area. So let's just say this was going down, we can continue and join it to go down. If this was going up, we can continue. They're not strong, so we can continue and join it. If this occurred in the middle of a chart, you can get in and join it. But if it's at the top, at a resistance area, or at the bottom of a support area, and this happens, nah. Like I said here, this is at the top. See that? So in the chart above, you can see how the trend direction changes after the pregnant lady pattern forms. The first bullish Harami pattern occurred at the bottom of a downtrend. Sellers were pushing the market lower. Suddenly, price starts consolidating and indicates that the selling power is no longer in control of the market. Look at it playing inside this whole entire bar. It's playing inside this whole bar. Okay? The bearish Harami is the opposite of the bullish. This one occurred at the top of an uptrend, which is up here, right? Indicating that the buyer's domination is over and the beginning of a downtrend is possible. Playing around this area and then out. This also looks like an evening star. When this pattern is created during an uptrend or a downtrend, it indicates a continuation signal with the direction of the market. Notice it said during. It's not saying at the end or at the top or the bottom. It says when this pattern is created during an uptrend or downtrend, it indicates a continuation. Let me see if I'm missing anything here. Okay. Okay, now we're at the tweezers. Top formation is considered as a bearish reversal pattern seen at the top of an uptrend, and the tweezer bottoms formation is interpreted as a bullish reversal pattern seen at the bottom of a downtrend. A lot of words for, it's just a rejection. Two bars, same size, bear and bull together, rejecting the same area. So imagine a doji candle split into two bars. This is like a yin and a yang. They're together at the same spot, staring each other down like, what's up? Okay. The tweezer top formation is considered as a bearish reversal pattern. Cool. Tweezer top. The tweezer top formation consists of two candlesticks. The first one is a bullish candlestick followed by a bearish candlestick. And the tweezer bottom formation consists of two candlesticks as well. The first candlestick is a bearish followed by a bullish candlestick. So we can say that the tweezer bottom is a bullish version of the tweezer tops. The tweezer top occurred during an uptrend when buyers pushed the price higher. This gives us the impression that the market is still going up. This is the tweezer top. The market is still going up. But sellers surprised buyers by pushing the market lower and closed down the open of the bullish candle. That's explaining those two candles. This price action pattern indicates a bullish trend reversal, and we can trade it if we can combine this signal with other technical tools. The tweezer bottoms happen during a downtrend. When sellers push the market lower, we feel that everything is going to be all right, but the next session prices close above or roughly at the same time as price. It's all just explaining this. And what does this mean? You have a bull candle and a bear candle almost the same size. The next session price closes above or roughly at the same price of the first bearish candle, which indicates that buyers are coming to reverse the market direction. If this price action happens near a support level, it indicates that the bearish reversal is likely to happen. So we're in a downtrend, same size. We can anticipate a reversal. Why? Because look, we're not going lower. See here? Same sizes. You can also see it here. Right here, you're out. The chart above shows us a tweezer bottom that occurred in a downtrend. The bears pushed the market downward on the first session. However, the second session opened where prices closed on the first session and went straight up, indicating a reversal buy signal that you can trade if you have other elements to confirm your buying decision. Don't focus on the name of a candlestick. Try to understand the psychology behind it, which is why I keep saying I don't really care about shadows or the names or anything. You just want to understand how it looks and how it plays out. Yeah, you pretty much just said what I just said. Candlestick patterns exercise. Now I think you can get some information about candlesticks, but you know the anatomy of each candlestick and the psychology behind its formation. Let's take this exercise to test your knowledge. Let's go. What's number one? Yes, it is. Number two? Number three? Is that? I would go. I could be wrong. I would say it's an engulfing candle. Engulfing. For bull or bear? Bull? And this would be bear. Okay. This one? Bull? For which one? This is Harami. Harami. What is this? And 7? Okay. And you see 7 is the opposite of 1. Okay. Number 1, bullish Harami. Okay, you have all your answers right here. Number 2, bullish tweezers. You said tweezers. 3, engulfing. 4, engulfing. 5, engulfing. See? I'm saying engulfing. They look the same. Don't need to overthink it. Engulfing, engulfing, engulfing. Number 7 was Harami. I believe you said that. 1 and 7 are Haramis. Yeah. Good job. All the other ones, engulfing, engulfing, engulfing. Okay? Let's take another exercise. Go. My bad. Which one? Number 2 is that one candle. Okay. Number 3? Okay, let's see if you're right. Number one. Number one is a bull. Number two is a hammer. Number three is a hammer in which the large body plus the smaller body is a baby, so it's a Harami pattern. Mm-hmm. Yep. Because it's not this. These are this is a doji. This is a baby. Okay. Remember, it's in the middle, playing in the middle. Okay. Number four was a bullish engulfing bar, which is what I said. What did you say? Bullish. Okay. Yeah, do your homework. This is great homework for anyone to do. Go identify these at the bottom or tops or in the middle of trends and see what you can get. Now that you have all these candlestick patterns to go play with. Market structure. One of the most important skills that you need as a trader is the ability to read market structure. It is a critical skill that will allow you to use the right price action strategies in the right market condition. You are not going to trade all the markets the same way. You need to study how the markets move and how traders behave in the market. The market structure is the study of the market behavior. If you can master this skill when you open your chart, you will be able to answer these important questions. What are the crowds doing? Who is in control of the market, buyers or sellers? I don't know what crowds is, but who is in the control of the markets or buyers? I mean, the market buyers or sellers, that you can see from a glance. What is the right time and place to enter or exit the market and when do you need to stay away? Through your price action analysis, you will experience three types of markets: trending markets, ranging markets, and choppy markets. In this chapter, you will learn how to identify every market and how to trade it. Trending markets. Trending markets are simply characterized by a repeating pattern of higher highs and higher low in an uptrending market, or lower highs and lower lows in a downtrending market. So, trending market going up, this would be going up. It never goes straight away like this. Shoom. It doesn't do that. It's going to go up, down, up, down, up, down. And higher highs and higher lows would be higher high and then a low. The low doesn't take out the previous low, so it's a higher high and a higher low. Higher high, higher low, higher high, higher low. These lows down imaginary right here are never being broken. See the example below. There you go. So you have your higher high, your higher low, never took out this low. Higher high, higher low, never took out this low. See that? Okay. As you can see in the example above, the market is making a series of higher highs and higher lows. You don't need indicators to decide if it's bullish or bearish, just a visual observation. This is why I zoom out to see the big picture of what's going on. Okay? Now look at the example of downtrend, lower highs and lower lows. So this would be a lower high, lower low. Took out this low, never took out this high. So that's a lower high. It's lower than this high. Lower low, lower high, lower than this high, lower low, lower than this low, so on and so forth. Okay. The example above shows a bearish market, as you can see, you know all that. According to statistics, trends are estimated to occur 30% of the time. They do not occur a lot in the market. So while they're in motion, you've got to know how to take advantage of them. To determine whether a market is trending or not, you have to use bigger time frames such as the 4-hour, the daily, or the weekly time frame. Never try to use smaller time frames to determine the market structure. Higher time frames give you your direction. How to trade trending markets. If you can identify a trending market, it will be easy for you to trade it. If it is a bullish market, you will look for a buying opportunity because you have to trade with a trend. If the market is bearish, you have to look for a selling opportunity. Follow the trend. The trend is your friend. Simple as that. Only if it's in a trending market. You don't just go wake up and say, the trend is my friend, I'm going to go look for a trend. You have to see what kind of market you're in. If you're in an uptrend, there you go. See the example of trending markets are characterized by two important moves. The first move is called the impulsive move, and the second one is called the retracement. Retracement, pullback, retest, all the same thing. Impulsive move, real move, however you want to call it, different name, same concept. As you can see, the market is making higher highs and higher lows, which indicates a bullish market. If you see this market, you will think of buying. But as you can see, the market is making two different moves. The first move is the impulsive move, and the second one is the pullback or the retracement move, the corrective move. Professional traders understand how trending markets move. They always buy at the beginning of the impulsive move and take profits at the end of it. This is the reason why the market makes an impulsive move in the direction of the trend and retraces before it makes another impulsive move. Let me read that again. Professional traders understand how trending markets move. They always buy at the beginning of an impulsive move and take profits at the end. They buy over here and take profit over here. This is what we talk about, catching the retracements. Now, are they safer? Yes. Do they pay the same? Obviously not. At the end, you get your candlestick pattern and you take it for the ride. This is the end of a downtrend. You get a candlestick pattern down here on a lower time frame. This is the daily. Analyze this area, might be a key zone, see what candlesticks are popping up, and then you go in for the buy. And fuck it up, fuck it up, fuck it up. Okay. This is the reason why the market makes an impulsive move in the direction of the trend and it retraces before making another impulsive move. If you are aware of how trending markets move, you will know that the best place to buy is at the beginning of an impulsive move. Traders who buy an uptrend market at the beginning of a retracement move, they are caught by professional traders. They don't understand why the market hit their stop loss before moving in the predicted direction. So we do say, get the retracement and take it up. Now, you can get in here and your stop loss will get hit and this will be the real move. You understand what I'm saying? Again, you can get in here. Oh, no, where is it again? This one will take you out, real move will made, and then now you feel like you missed the move. That's retail trading. You got in over here, your stop loss definitely got hit out of here again. Retracement over here, you're gonna go up here, your stop loss got hit. And out. Yeah, just because I'm saying your stop loss got hit doesn't mean your trade went negative. I'm just saying that's back at entry and you're pretty much almost closed. Okay. Vice versa for the other way. You want to catch these. These are the ones you want to catch. The retracement is safe. That's trying to be a safe trader. But if you don't understand what you're doing, you will get your trade taken out. You want to catch, look at these. It's never coming back. It's never coming back to impulsive moves. But the retracement, if you get in and sell over here, look what happens. Look what happens. Look what happens. The illustration above shows that, yeah, I'm not going to go over all that. To predict the beginning of the impulsive move in a trending market, you have to master drawing support and resistance levels. So what are support and resistance levels and how to draw them on our charts? So let's go. Support and resistance are proven areas where buyers... All right, so support and resistance are proven areas where buyers and sellers find some equilibrium. They are major turning points in the market. Support and resistance levels are formed when price reverses and changes direction. And price will often respect these support and resistance levels. In other words, they tend to contain price movement until course breaks through them. So, support level, it's a key point where the market comes and turns around. Key point, the market comes around, turns around. Now, swing points, higher highs. Okay? In trending markets, support and resistance are formed from a swing point. In an uptrend, the previous swing point acts as a support level, and in a downtrend, the old swing point acts as a resistance level. So, comes here, reacts, breaks, respects, breaks, respects, breaks, respects, breaks, respects, opposite way. Respects, breaks, respects, breaks, respects, breaks. Make sense? Mm-hmm. Zoom that out a little bit. The illustration above shows how the previous swing point acts as a support level after a breakout. When the market makes the retracement, when the market makes the retracement move, it respects the previous swing point, the support level. Forget swings, it's support and resistance, which will represent the beginning of another impulsive move. As you can see, when the market tests the previous swing point, support level, it goes up again. Swing point, support level. See that? Never took out this high, like we were going over last night. It didn't take it out from before. So look at that again. Didn't take it out from before. Make sense? Cool. So the downtrend market, same thing. Swing point, never took it out. Never took it out. Never took it out. Okay? The market makes an impulsive move. If you understand how price action act in the trending market, you will predict how with high accuracy when the next impulsive move will begin. Another way to catch the beginning of an impulsive move is by drawing trend lines. Now again, going to the impulsive move, you don't want the retracements. This is like advanced trading. If you don't learn 100 like indicators, 100 EMAs and stuff like that, if you don't learn that from the jump, and you want to understand how to catch, instead of these, you want to catch the impulsive move from the highs, stop loss above the high, you actually have a better probability trade than catching a retracement or waiting for a retracement. As we learned, the retracement only happens 30% of the time. We're talking about a whole year. 70% is no trend. So if the market's only trending 30%, I'm not going to catch retracements. That's why I'm going to say that the market is choppy or the market didn't go my way. That's a really big waste of time. You want to be able to understand how it's going both ways. So if you're just waiting for pullbacks every single time, like the other mentor said, it's lazy. You're just being lazy. So moving on. Don't care about that swing point. The market makes an impulsive move. These rim price actions in the trending market. We got that. How to draw trend lines. To draw a quality trend line, you will need to find at least 2 minimum swing points. We've said 3. And simply connect them with each other. The levels must be clear. Don't try to force a trend line. Don't use smaller time frames to draw trend lines. Always use 4 hour and up. I like using 4 hour and up. 4 hours is the beginning of smaller time frames. And the daily times to find obvious trend lines. 4 hour, daily, and up, there's direction. You get the direction of the market from the 4 hour and up. We will try to focus on how to draw trend lines. I'll actually just go down and look at that. They're clear. They're clear. Very clear. You shouldn't have to try to connect them and see where they're at. It's very clear. As you see, the market respects the trend line. When the price approaches it, the market reverses and continues in the same direction. When the market moves away from trend lines, helps us to anticipate the next impulsive move in the direction of the market. So we have it here, here, here. It's breaking it now. Right? As you can see, the market respects the trend line, and by drawing it the right way, we can easily predict the next movement upward. This is all what we can say about trending markets. I think it's clear and simple. Yes, that's pretty much a trending market, so we can move on from there. The ranging market. Ranging markets are pretty straightforward, and they are often called sideways market, consolidation markets, because their neutral nature makes them appear to drift to the right horizontally. So there we go. This is what other people would call zone to zone, zone to zone, zone to zone, zone to zone. But when it stops making these consecutive peaks, we say that the market is ranging. The ranging market moves in a horizontal form where buyers and sellers just keep knocking price back and forth between support and resistance levels, zone to zone. The chart above shows a ranging market. As you can see, the price is bouncing between horizontal support and resistance. The difference between trending markets and ranging markets is that trending markets tend to move by forming a pattern of higher high and higher lows in case of an uptrend, and higher low and lower low in case of a downtrend. Again, zone to zone. Ranging markets tend to move horizontally between key support levels, so it's just playing in between these zones. Buyers and sellers, bulls and bears are just knocking it in between this area over and over. Your understanding of the difference between both markets will help you better use the right price action strategies in the right market conditions. Trading ranging market is completely different from trading trending markets. Trading ranging markets is completely different from trading trending markets, because when the market is ranging, it creates equilibrium. Buyers are equal to sellers. There's no one in control. So you have to understand that you're not riding a trend. So this, for me, from what I'm understanding, is that's scalping. You're just riding it zone to zone. You're not in it for the long run. You're just in it for a short term. The best buying and selling opportunities occur at key support and resistance levels. So that would be all these boxes. You're not getting in over here. And again, this would be a pullback. This is like waiting for the breakout. You want your breakout and retest. Now, as much as we understand that, you have to be able to see what market that you're in. It's not always a trend. You catch a pullback on a trend. For this is now zone to zone. We want to get in over here and over here, stop loss above here. If I get in over here and my stop loss is 10 pips or 15 pips and it hits this and goes the right way, I fucked up, right? Trading ranging markets is completely different than this will generally continue until the range structures break out and the trending condition starts to organize. So what they're saying is this will continue until this happens. It breaks out. There are 3 ways to trade ranging markets. I'm not going to go into details because what I want you to get here is a skill to look at your charts and decide whether the market is trending or raging. In the next chapters, I will go into if you cannot differentiate between raging and trending markets. Ranging, zone to zone, trending, higher lows, higher highs, lower lows, and lower highs. Ranging market. See, you're buying at our key support level. This is support, so we're buying here, we're buying here, we're buying here. Our stop loss obviously got hit, but it's a safe trade because our stop loss is below here. If it breaks through the zone, we know it's going the other way. So ranging markets are zone to zone, and trending markets are when the market is making higher highs, higher lows, or lower highs and lower lows. As you can see, the market is moving horizontally. In this case, the best buying opportunities occur at the support level. The second way of trading ranging markets is by waiting for the breakout from either the support level or the resistance level. So you're waiting for this breakout over here. So that's the 2 ways, zone to zone or waiting for the breakout. What is ranging? And cool. What is the trending market? Higher highs for what type of market? And lower lows for? Cool. When the market is ranging, no one knows what is going to happen. We don't know who is going to be in control of the market. This is why you have to pay attention to the boundaries, the zones. But when one of the players decide to take control of the market, we will see a breakout, as you did with that bear candle, of the support and resistance level. The breakout means that the ranging period is over and the beginning of a new trend is starting. So the breakout will be your first, on that bear candle, your first lower low. Well, your first low, then it has to make a lower low. Before it makes a lower low, it has to do what? Nice. See that? It broke out. Everybody's waiting for this one. While everybody's waiting for that, look what happened here. What's a more high probability trade? I already got my breakout. I could buy here with my stop loss back into this zone. This one's my stop loss below this area. And I guarantee you that this is a shorter stop loss than this. Because if you get hit here, then another trader will say you should have put it here. And another trader will say you should put it here. As you can see, the market was trading between support and resistance levels. And suddenly the price broke out of the resistance level. This indicates that the beginning of a trend is likely to happen. So the best way to enter is after the breakout. It is important to remember that range boundaries are often overshot. Giving the illusion of a breakout is occurring, this can be a very deceptive and does trap a lot of traders who position into the breakout. The third way to trade a ranging market is ranging markets is to wait for a pullback after the breakout of support and resistance level. This would be your retest over here. The pullback is another chance to join the trend for traders who didn't enter the breakout. Pop quiz, what's the joining the trend? We had a candlestick pattern for that, for joining the trend. Was morning and evening? Okay. Resistance, support, breakout, this pullback. This is what I meant by the zone. Not these. This one, the retest of the zone. This is also called a double. So it's a double what? Yeah, double bottom. As you can see the chart above, the market was ranging. Price breaks out a resistance level to indicate at the end of a ranging period and the beginning of a new trend. Now, or how I look at the market, we have our zones marked up. We have price, buyers are here, sellers are losing. We have a breakout to the upside. It broke out of our zone. Am I buying here? No, 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 no. I'm seeing over here, the price is settling. It came and retested my area. I'm sticking to my bias because I have my direction. My direction was this is my key zone. Am I looking for sellers here? No, because you came out of my zone. You retested my zone. Click, 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 shot, 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 also a shot, out of here. This is where you shoot. We're shooting all of these candles here. We're shooting because it rejected, and I don't see any sellers coming back down here because this candle is beaten by this candle. This candle is still beaten by this candle. You can still get in here. This is also in Harami, which is a continuation. Can we see that? Mother candle, then the baby candle. Out of here. See how that makes sense? So we have a resistance, our support, our breakout of our zone. We're looking for price action. We have a doji. We have our mother candle. What more do you need? Make sense? Okay. As you can see in the chart above, the market was ranging. Price breaks out of resistance level to indicate the end of the ranging period and the beginning of a new trend. After the breakout, the market comes back to retest the resistance. This is everything I just said, isn't it? This is wow. Okay. So forget all that. What you have to remember is these are the key levels you have to focus on. The breakout of the support or the resistance level indicates the ranging period is, so breaks out of our zone, continuation. Yep, no more ranging. Ranging is zone to zone, trending is higher highs, higher lows. So now we have two types of market understood. If you miss the breakout, wait for the pullback. When it occurs, don't hesitate to enter the market. We had our candlestick patterns, we had everything we needed. When you are trading ranging markets, always make sure that the market is worth trading, so you want to get in at support or resistance. This is a clear indication of a choppy market. Oh, whoa. When the ranging markets, always make sure that the market is worth trading. If you feel like you can't identify boundaries, if you cannot find a support or resistance, don't force it. Market choppy. In Forex, choppy markets are those which have no clear directions when you open your chart. If you find a lot of noise, you can't even decide if the market is ranging or trending. Why? Stay out of it. Leave it alone. Okay. You have to know that you are watching a choppy market. This type of market can make you feel very emotional and doubt your trading strategies as it starts to drop in performance. This is a big fucking fact. You will get emotional and doubt your trading strategies because you cannot find this. You cannot find a structure. You cannot find something. So leave it the fuck alone. There's many other trading. There's other pairs. There's other pairs to look at. There's other time frames to look at. Do your homework. Do a top-down analysis, which is from the higher time frame to the lower time frames. If you don't see anything after you check all your boxes, leave it the fuck alone. What I mean by checking your boxes, see if there's zones. See if there's support and resistance. See if there's higher highs, higher lows, lower highs, lower lows. Is there a big candlestick pattern? If all five of those are giving you an issue, forget it. Leave it alone. The best way to determine if a market is choppy is by zooming out on your daily chart and taking in the bigger. This is exactly what I should read further before doing this. But a lot of big words and a lot of noise for no reason. After some training, screen time, and experience, you will easily be able to identify the market as ranging in a choppy market. This is definitely a choppy market. The market is not going nowhere. This is also at the low of somewhere, so you can just wait. This is one that you just box around it and say, I'm waiting for price to break out this area. And specifically, see this red at the top of this box? I don't know if I did this on purpose, but look to the left. Mid-range, this could also be resistance. But we're waiting for a breakout of this area, a retest of this area, and then take off. So box the areas that you're waiting for and see what happens when it breaks out of those areas. Then you can find a better probability trade. Notice in the chart above, the price action is highlighted in the area, very choppy, and is moving sideways in a very small, tight range. This is a sign of a choppy market that you should stay away from. If a market is choppy, in my opinion, it's not worth trading. If you try to trade it, you will give back your profits. This happens to a lot of people because markets often consolidate after making big moves. So all of these guys over here are hoping to catch the sell. And I bet you they're going to lose all their money. Time frames and top-down analysis. As a price action trader, your primary time frame is the 1 hour, 4 hour, and a daily. Don't tell me what my time frames are. I can do whatever the fuck I want. Any trader can do whatever the fuck they want. You top-down analysis, start from the top, move your way down. I'm going to read this as an instructional part. I'm not agreeing with anything yet. So let's see. I'll tell you how I feel about it and then give you the definition. So as a price action trader, your primary time frame is the 1 hour, 4 hour, and a daily. Okay, good time frame. Price action works on a bigger time frame. If you try to trade pin bars or engulfing bars on the 5-minute time frame, you will, didn't I say this? I wouldn't use the 1 minute or the 5 minute because there's a lot of noise on smaller time frames and the market will generate a lot of false signals because of the hard battle between bears and the bulls. Before going, no, I'm gonna wait to say that. Besides, there's no successful price action trader who focuses on one time frame to analyze his charts. Yes, you cannot focus on one time frame to look at Forex. Maybe you have heard of the term top-down analysis, which means to begin with bigger time frames to get the big picture and then switch to smaller ones to decide whether to buy or sell the market. Higher time frame, you get your direction of the market. Lower time frames, from that direction, you stick to it and enter the market. Stick to your bias. Let's say you want to trade the 4-hour chart and you have to look at the weekly chart first and then the daily chart. If the weekly and the daily charts analysis align with the 4-hour, you can take your trading decision. See what I mean by sticking to your analysis? They took 2 time frames, concise down to the one lower than that, and then entered following the higher time frame. And if you want to trade the 1-hour chart, you have to look at the daily chart first. This is a critical step to do as a price action trader because this will help you avoid low probability trading setups and will allow you to stay focused on high probability price action signals. Through our top-down analysis, we will always start with a bigger time frame and we will look to gather the following information. What's pissing me off a little bit is I don't see anything about the 15-minute. You're telling me to go start on the 1 hour. This is what I mean by you can do whatever the fuck you want. Yes, the 1 minute and the 5 minute. 5 minute, you can get an entry on the 5 minute. Try to follow me on this. If I have a 4-hour direction and I look at the 1 hour and I see it following the 4-hour direction, and then I want to go drop it down to the 15-minute, and the 15-minute is following my 1 hour and 4-hour, is that not the same thing as the daily and the weekly to the 4-hour entry or the 1 hour? It's the same shit. Just apply the same concept to the time frame. So you want 2 higher time frames and then drop it down to a lower time frame from that to get your entry, following the same directional bias, following the same direction. If 2 other, try not to get confused, if 2 other time frames, like the 4-hour is showing me a buy and the daily is showing me a sell and the 1 hour is showing me a sell and the 15-minute is showing me a buy, I'm all fucked up. You need to find the right directional biases. And then once you get your directional bias, drop it down and stick to that bias. Find your confirmations. The 15-minute, I will find my price action. Cool? Cool. The most important support and resistance levels. These areas represent turning points in the market. If you can identify them on the weekly chart, you will know what is going to happen when the price approaches these levels on the 4-hour chart. Take your higher time frame and drop it down. So if your support and resistance levels are being respected on a lower time frame, that is what this is telling you. This can be very misleading, but once seeing the weekly and the 4-hour, because it gives you a trading method, but you're not comfortable with it. You need to be able to understand every single time frame that Trading View or MetaTrader 4 gives you. So if you get the daily, or if you get, monthly, weekly, daily, 4-hour, 1 hour, 15-minute, 30-minute, 5-minute, 1 minute, understand what is going on those time frames. And the best way to describe that is 1 hour to the 4-hour, 4-hour, 1 candle on the 4-hour is 4 candles on the 1 hour. 4 15-minute candles is 1 hour candle on the 1 hour chart. If you can understand that, you will be very well off than whatever anybody tells you. Go look at the weekly, then go look at the monthly, then go look at the daily, then go look at the 4-hour. Just understand the breakdown of the candlesticks. So you will decide either to buy or sell, to ignore this. Yeah, okay, cool. Market structure. Here we go again with the analysis. The weekly analysis will help you identify if the market is trending up or down, or it is ranging or a choppy market. If you don't have higher highs or higher lows, that's how you understand if the market is trending. In general, you will know what big investors are doing. You will try to find a way to follow them, follow the direction of trend, because trend is your friend. On a smaller time frames, using price action strategies. The previous candle, the last candle on the weekly chart, is important because it tells us what happens during a week. That I agree with. If you understand what a candle means on a specific time frame and can go chop it up on the lower time frames, you will be able to see how it plays out. This weekly candle was a bull candle. So this means this whole week, if I go on the daily, 7 candles there is 1 week. I mean, well, 5 candles there is 1 week. Then you're going to see that those 5 days it went up. Then for the 4 hour, I will see the pullback. For the 1 hour, I will see the pullbacks of those areas because I'm following the bulls. I don't care about the bears. I want to focus on the bulls because it went up. If that was an analysis, just saying. The last candle on the weekly chart is important because it tells us what happens during a week. It provides us with valuable information about the future market move, like I said. When you identify these points using the weekly chart, you can now move to the daily chart or the 4 hour chart and try to gather information such as the market condition. Now, look what they said. Using the weekly chart, you can now move to the daily or the 4 hour chart. 2 charts, 2 time frames. I keep saying that. Get 2 time frames and then drop it down. The market condition. What the market is doing on the 4 hour time frame, is it trending up or down? Is it ranging or is it choppy market? What are the most important key levels on the 4 hour or the daily time frame? This could be support and resistance, supply and demand, and trend lines. Price action signal, a candlestick pattern that will provide you with a signal to buy or short the market. This could be a pin bar, an engulfing bar. Let me send this to the chat because I feel like people don't understand that. Ooh, ooh. Boom, boom, boom. Okay. Let me give you an example to help you understand why it is important to adopt a top-down analysis concept in your trading method and what is going to happen if you don't look at bigger time frame before switching your primary chart. Weekly time frame. Proven turning point. This is what we saw in GBP USD, right? Proving turning point, risky to buy through the level. I didn't want to take the buy. I wanted to sell it, and then news broke through it, which is completely fine because that's a safe risk. That's a risk to reward trade because I'm risking what has happened before and seeing that it will happen again. Now, what we can see here is it risky to buy through the level? Looking at candlestick patterns? No, because look at these compared to this. Look at this rejection. Look at this rejection. I didn't get that rejection. This is a weekly time frame. So for a whole week, 2 weeks, it didn't reject. This rejected immediately and retested it again and went out of here. As you can see in this weekly chart above, we have gathered 2 important points that will help you decide what to do on a daily time frame. The first point is that the market approaches to an important weekly resistance level and will represent a hot point in the market. The second information is the rejection from this key resistance level. As you can see, the price was rejected immediately when it approaches the level. This indicates that there are sellers there and they are willing to short the market. Makes sense. They're neutral right now. They're trying to win. There's a war right now at that level. What confirms our analysis is the formation of the inside bar false breakout patterns that indicates a reversal. That's the same area I was talking about. But they're saying risky to buy through the level. Hey, now let's switch to the daily time frame to see what's going on in the market. Now we're going to go get more data. This is what it means by to get more data. The major weekly level, bullish candlestick buy signal. See that rejection to the low? See that? Okay, this is the daily time frame. On the daily chart, we have a clear pin bar candlestick pattern that indicates a bullish signal. Yep. If you focus just on one time frame to make your trading decision, you will buy the market because there's a clear pin bar signal. But if you analyze the weekly chart, you would know that there is a very powerful key level that will stop the market from going up. So it is better to think of selling the market if there is a clear signal rather than to buy it. Look at what happened next. Daily time frame, candlestick buy signal, came to the area, sold. That's what I thought was going to happen with GU, but it went the other way because of news. This was NFP. Top-down analysis wins. The bullish candlestick signal did not survive long after the market moved into the weekly turning point. Higher the time frame, stronger the zone. The elements from the higher time frames can be such a power feature that they dominate over signal. Wait, what? That they dominate over signal on your trading time frame. Yeah, okay. Top-down analysis is pretty much higher time frame, stronger zone. That's a much simpler way of what with elements and all that shit. As you can see, the top-down analysis worked. The pin bar candlestick signal didn't work. Not relying on solely a candlestick pattern for your entry, you have to make sure everything ties in together. It has to be 3 elements. It has to be 3 things to come together. So 3 confirmations. You need zones. You need to find out what type of market you're in. You need a price action confirmation for the same direction of your bias. How to get confused on that very quickly. If I'm in a ranging market and I'm in the middle of a zone and I see a bullish engulfing candle on the 1 hour, I don't give a shit, because if it's sideways and it's in the middle, my probability is 50%, not even 50%, because you're in the middle. So to clarify what I'm saying, if we're over here in the middle of it, this is at a zone. This is not a zone. And I see, like, I don't know, let's say over here, rejection to the low in a bull candle. This is the mother candle, right? And I got in over here. That definitely took me out, right? And I didn't move at all either. You want to get in at the top. You want to get in at the zone. You want to make sure everything gets in together. For pullbacks in the trending market, it's different. You want to get in on the retracement, where it breaks out and retests your area. You get in there and then take off, but you have to understand what type of market that you're in. Trading counter trends is very profitable as well, but without the top-down analysis, you will put yourself in trouble. You can trade against trend as long as you're at a key zone and you have your price action confirmation. So let me give you another how to trade counter trends using price action setups in combination with the top-down analysis. Let's see what he got here. Okay, weekly chart, proven weekly turning point. Price now at anticipated turning point. You can see we have our bear candle right there. Price at a major resistance. The price is now at a level where it is highly anticipated a reversal will occur. How do we know? Because it has been proven major result. It has been a proven major reversal point in the market. If we look to the left, like I said before, history repeats itself. From here, we only have clear option. Look for sell signals on our trading time frame from the weekly. As you can see in the chart above, prices are at a weekly resistance level. Buyers were rejected twice from this level, which indicates that the market is at a hot point and is likely to reverse. What you can do as a price action trader is to switch to the daily time frame to look for a selling opportunity. If you can find a price action setup near the weekly resistance level on the daily time frame, this is going to be a high probability setup to take into consideration. Derived from the weekly chart in our top-down analysis, counter trend bearish reversal candlestick pattern. Right here. So we have wick, doji, doji. The daily chart above confirms our weekly analysis. As you can see, there is a clear bearish signal near the weekly resistance level. The pin bar was ejected from that level, and there is also the formation of an inside bar false breakout. This is a clear indication of a trend change. See what happened next. Out of here. So safe to wait for all of this. That's the breakout. This is your retest. Final time. Never broke this high. So this never broke this high. Out of here. The example above shows that counter trend works if it is well mastered. It is a contrarian approach that requires experience. So if you are a beginner, I highly recommend you stick with trend. Yes. But if you can understand this right from the jump, this is my approach to it. If you can understand this before learning trend, trend becomes easy. You're just looking for pullbacks. But if you can understand this right from the jump, highs and lows and breakouts and retests, then you can get a better understanding. There are many approaches used to time the market turns and plan trades. The most of these approaches lead to greater confusion and lack of confidence in results. Lack of confidence is a big thing, because if you have trend, it gives you that more comfortable hug Like, I know I'm in the right way. I know this is a trend. I know this is the pullback. When you don't have a trend, you don't have any crutches to hold yourself up. You just have to trust your analysis. Simple as that. Keeping the analysis simple is Keeping the analysis simple is the most often the best way to go, and a top-down analysis is one of the easiest approaches that I recommend to master if you want to trade the right way. What you have to do right now is open your charts and try to find and practice what you've learned in this chapter. Try to identify the market trend using these techniques. It will be a little confusing at the beginning. Okay, cool. Any pop quizzes? No. In the last chapters, you learned 3 important aspects of price action trading. The first aspect is the market trends. You know how to identify the market trend using multiple time frame analysis. You know how to differentiate between trending markets and range-bound markets. And you understand how each market moves. Are we good there? Okay. The second aspect is the level. You learn how to draw support and resistance level, how to draw trend lines. This skill will help you better enter the market in the right time. The third aspect is the signals, the entry. You have seen different candlestick patterns. You understand the psychology behind its formation and the message they send you. These 3 aspects, which are the trend, the level, and the signal, are what we will use in our trading approach to make money trading in any financial market. I mean that when you open a chart, you will try to answer these 3 questions. What is the market doing? Is it trending, consolidating, or is it a choppy market? I would write those down, these 3 questions. If it is trending, you know how to identify if it is an uptrend or downtrend. If it is ranging, you will see that it is trading horizontally between 2 boundaries. And if it's choppy, you choose to close it and stay away. What are the most powerful levels in the market? If the market is trending up or down, or is it ranging, you will try to find the most important support and resistance levels. These levels are the best zones where you can buy and sell the market. And the last question is, what is the best signal to enter the market? The best signal to enter the market means the right time to execute your trade. Forex is 100% being on time. You can enter a trade. If you're too early and you're sitting in consolidation, waiting for your trade to go into profit, and you get faked out, you get scared, you're tired of waiting, you're impatient, you close your trade, and what happens? You miss the move and the trade goes the way you wanted, and now you're sitting there bitching, right? So the best time, the best signal to enter the market, you want to wait for it all to line up, okay? The pin bar candlestick pattern strategy. The pin bar candlestick is one of the most famous Japanese candlesticks. It is widely used by price action traders to determine reversal points in the market. In this section, you will learn in detail how to identify potential pin bar signals and the conditions needed for high probability setups. A pin bar is a chart candlestick. It is categorized by a very long tail, very long wick, that shows rejection and indicates that the market will move in the opposite direction. The area between the open and close is called the real body. Typically, all pin bars have a small real body and a very long wick. A bullish pin bar is known for its lower wicks, and the bearish one is characterized by long upper wicks. The color of the candlestick is not quite important. However, bullish candles are white and they're black. Okay. On the other hand, a bearish pin bar with black real bodies are more important than the ones with white real bodies. See how pin bars look like. Big wick rejections. Big wick rejections. To be honest, quality price action setups don't exist in the market, because you will see that sometimes you can find a high probability setup. You feel very excited about it. You take your trade with confidence, but at the end, you'll be frustrated because the signal fails for unknown reasons. That happens a couple of times because the market doesn't move due to pin bar formations. What moves the market is the law of supply and demand, the law of attraction. Let me give you an example to identify a quality pin bar candle next to a support key level in an uptrend market. This is a powerful buying signal to take. You shouldn't ignore it, but if the amount of money that buyers put in this trade is less than the amount of money that sellers risk in the same trade, the market will not go in your predicted direction. I'll read that again. If you identify a quality pin bar candle near a support key level in an uptrend market, this is a powerful buying signal to take. Pin bar candle rejection to a support level So a wick is to the support level. You'll see a buying opportunity because it wicked your support. You shouldn't ignore it, but if the amount of money that buyers put in this trade is less than the amount of sellers that risk the same trade, the market will not go in your predicted direction. Who is stronger? Simplify that. If the signal fails, it doesn't mean that your analysis is wrong or pin bars don't work. It's just because the market didn't validate your decision. Therefore, you accept your loss and look for another opportunity. You may ask yourself, why should we look for quality pin bar setups if the market doesn't respect them? As you know, trading is a game of probabilities. There is no certainty. This is why you should evaluate your pin bar setups from multiple angles, and the fact that you are looking for quality setups means that you are trying to put your probabilities of success in your favor, which the right mindset is for successful traders. So yes, this is a game of probability. There is no certainty, but the world is not predictable. I mean, the world is not rigged, but it's very predictable. We can see how people will react to certain situations. There's a higher probability of somebody being scared of a spider than somebody being scared of a cat. Simple as that. The pin bar formed in bigger time frames, such as the 4-hour or daily time frame, should be taken into consideration. Higher the time frame, stronger the zone. Because if you look at smaller time frames, you can easily spot a lot of pin bars. These setups should be ignored because smaller time frames generate a lot of false signals. I like the 15-minute. I will keep saying that. It's not that it isn't coherent to the rest of your analysis. It's very coherent. Pin bar in a daily time frame. The pin bar formed in line with the direction of the market is more powerful than the one formed against the trend. If you can identify a clear trend, that means that you know who is in control of the market. We're in a clear uptrend. The formation of this candlestick pattern with the trend makes it so effective. See the chart below. Bam. Pin bars with the trend. That's a pin bar. Rejection to the low, then take out this low. Rejection to the low, then take out this low, and so on and so forth. Pin bars against the trend. The trend is your friend. We're not taking the ones against the trend. We're in the uptrend market. Okay? As you can see in the chart below, in the chart above, bullish pin bars that were formed in a line with the uptrend work, and they should be taken into consideration. But the bearish ones that were formed against the trend should be ignored because you don't want to go trade against trend. And again, at the same time, I can see this pin bar, but this is my high. I don't give a shit. I can see how somebody would look at this for a sell because they're over here, but we have a higher low and a higher high. So you have to cancel out what you're looking at. You can see this and be like, okay, I see two rejections. I see a pin bar, but are we in a downtrend? No, we're not in a downtrend. So you have to see how your analysis weighs out the odds and the ends. The anatomy of a pin bar is important as well. You have to make sure that the candlestick is a pin bar by looking at the distance between the real body and the wick. Pin bars with longer wicks are more powerful. The psychology behind the pin bar candle formation. Pin bars are formed when prices are rejected. This rejection doesn't indicate a reversal signal because the price action setup can form everywhere in your chart. The most important areas to watch when you're trading pin bars are major key levels such as support and resistance, supply and demand, and moving averages. The formation of this candlestick chart pattern in these levels give a clear idea about what happens in the market. If the rejection was near a support level, for example, this is an obvious indication that the bulls are more powerful and they are willing to push the market to go upward. See the chart below. So, support level, pin bar, we have a breakout, a retest. This is textbook. Yeah. This is what we want. Not a double bottom, but we have a rejection. We have our pin bar. We have our evening star. You see the evening star? Yeah. That. Mm-hmm. You see our indecisive candle, our doji, because of this area over here, but we're still going to the upside. If the formation of this candlestick occurs near a resistance level, it indicates that the bears reject prices and prevents the bulls from breaking this level. So this means that sellers are willing to push the market downward. See the chart below. Same thing. We have a breakout of our area, We have a retest, rejection, pin bar signal, entry, out of here. Does that make sense? Same thing from the top. We have our breakout, our retest, our double top, our pin bar signal, price action, resistance level, 1, 2, 3, out of here. If you understand the psychology behind this price action pattern formation, you will be able to predict what is likely to happen. Just understanding what is going on in the market, marking your zone, and waiting for the right time to enter. If you sold over here, I don't have any price action over here. I have this now. That makes sense. This doesn't make sense. You're breaking. Okay, you broke. I'm not going to sell here now because this is the impulse. This is the decision that it made. Great, but not happening. Out of here. If you understand the psychology behind this price action pattern formation, you'll be able to predict what is likely. Blah, blah. Trading the pin bar candlestick with the trend. If you are a beginner trader, I highly recommend that you stick with the trend because pin bars that occur in trending markets offer good trading opportunities with high risk to reward ratio. When you master trading it with the trend, you can then move to trade range-bound markets or even counter trends. This strategy is simple. You start by identifying a clear uptrend or downtrend. You wait for the pin bar to occur after a pullback to a support and resistance level. Like I just said, we have our breakout, our retracement move, our rejection pin bar, out of here. The figure below shows how this price action signal works if it is traded with the trend. As you can see, the price was rejected from the resistance level, which indicates that the bears are still in charge of the downtrend. Right over here, they rejected and it was out of here. No. Oh, dang, what did I do? What did I do? Okay, cool, right here. The formation of the pin bar indicates the end of a retracement move and the beginning of the impulsive move at the resistance level in line with the downtrend. This is a high quality setup because of the following criteria respected. The pin bar is well formed. It is in line with the direction of the market. I'm going to keep going back and forth. The pin bar that is formed, it broke out and retested, is in line with the direction of the market. The rejection occurred in a major key level, which represents a hot point in the market. So this was our support being retested as resistant. This is our floor being retested as a roof. Cool. The risk to reward ratio is good and is worth trading. Yes, because this is actually, no, I'm not, that's a whole different word I was going to go into. Never mind. Sometimes, even if the market is trending, we can't draw support and resistance levels because prices move in a certain way, which we can spot static key levels. If you are in the situation, you can use the 21 moving average, which will act as a dynamic support in an uptrend market and a dynamic resistance in a downtrend market. Now we're learning about new moving averages. 21 moving average acts at a resistant level. Pin bar signal in line with our downtrend. Okay? As you can see in the chart above, the market was trending down. Using the 21 moving average helps us to identify dynamic resistance levels and high probability pin bar setups. So this is a strategy using a moving average and a pin bar. Okay? Again, the method never changes. This is what I mean by the method. You're looking at market structure. Then the indicators get added on. You want to find the direction of the market, and then you start adding all these coloring things into it. Uptrend market, pin bar signal, retracement on 21 average, out of here. The 4-hour chart above illustrates how the 21 moving average could help us find key points in the market. When prices approach the moving average, the buying pressure takes place in the market and the price goes up because we're in an uptrend and the moving average is just telling us when to enter. Okay? The pin bar signal is clear on the chart because the trend is bullish and the price action setup has a bullish anatomy as well. And the rejection from the 21 moving average is a confirmation signal to buy the market. Trading tactics. When we identify the trend upward or downward and the level support and resistance, and we find a pin bar near these levels in line with the direction of the trend, the second step is to know how to enter the market based on this candlestick pattern. According to my experience, there are different entry options when it comes to trading pin bars. It all depends on the candle anatomy and the market conditions and your money management strategy. The aggressive entry point option. At a glance, I'm just thinking that's going to be at the zone. This method consists of entering the market immediately after the pin bar closes without waiting for a confirmation. This strategy will help you catch the move from the beginning because sometimes the price goes higher after the close of the pin bar and you are not in the market. The trade will leave without you. Well, no shit. If I'm not in the market, yes, no shit. Okay, so support becomes resistance. Our stop loss is above this wick. Entry after the close of the pin bar setup. This is your risk. This is your reward. And obviously, if you don't get in, no shit, this is going to leave me high and dry. The chart above shows how an aggressive entry could help you execute your trade in the right time without being left by the market. As you can see, we took this trade because we had three important elements: the trend, the level, the signal. The market was trending down, cool. In this chart, we had a support level that becomes resistance. Here, support becomes resistance. Rejected the shit out of it. Again, this was support, now it's a roof, out of here. This isn't hard if you're just sitting and looking at the market. Not even just sitting. That's just all the hard work. If you just sit here and analyze all of this, I have my bearish engulfing candle on the daily time frame. I have my retest down here. I have my pin bar. My stop loss is above here. I have my next rejection to the same area. Get in. And if it's over here, get in. Retest it. It never passed. But people would see this and say, stop losses at break even, or my stop losses in profit, takes you out. Now let's make the real move. A clear pin bar was formed after the retracement back to the resistance level. When you have these three elements in the market, you just place your trade after the close of the pin bar and your stop loss above the long wick. Your profit target will be the next support level in case of a downtrend. Your take profit is whatever amount of pips you want. It doesn't have to be at a certain zone. I would say a safe one to start with is 20 pips. These three elements are quite enough for you to have a high probability entries in the market. The conservative entry option, this strategy consists of entering the market after 50% of the range bar retracement. This is what we've been telling everybody. This is like fibs. This is like moving averages. This is the retracement. This strategy sometimes will work and will give you more than 5-to-1 risk-reward ratio, and sometimes the market will leave without you. See the illustration below. There we go. So we have the downtrend. This is our support, the break, our pin bar to our resistance level, 50% pin bar retracement entry right here because of over here, not to the zone. Hold it, out of here. Did they put the time frame in? 4 hours. Hold your trade and out of here. The illustration above gives us an idea about the power of conservative entries. As you can see, this entry method helps us decrease our risk and increase our rewards. The trade above has more than 5-to-1 risk reward ratio. One trade like this every month is quite enough to generate a decent income. See another chart below. That's something to think about, people who have this book and don't read it. One of the drawbacks of this entry point is that the market sometimes doesn't retrace to 50% of the range bar, which will make you feel frustrated because the market will move to the profit target without you. As you can see here, 50% pin bar retracement entry, stop loss here. There is no wrong or right entry point. I mean, like getting in down here, this is watching and then waiting for the candle to close. You're going to miss the entry that you really wanted. So coming down here, once you start seeing the wick form, your entry's down here. Nobody's getting this. Nobody got that entry. You're getting this. We all have to be realistic. We're not going to get like the super snipe. You're going to get this entry over here, and your stop loss has to be below your zone. There is no right or wrong entry point. That both are work great, but with screen time and experience. This is what I'm saying. You have to sit here and look at it. You'll be able to decide whether to trade aggressively or conservatively. Personally, like aggressively. Other people like conservatively. Trading pin bars with confluence. This was the word I didn't want to say earlier. Confluence. Confluence happens when many technical indicators generate the same signal. This trading concept is used by price action traders to filter their entry points and spot high probability signals in the market. It doesn't matter if you are a beginner or advanced trader. Trading with Confluence is a must because it will help you focus on quality setups rather than quantity. It will enhance tremendously your trading performance. Now, here, confluence means combination or conjunction. It is a situation in which two or more things join or come together. For example, if we are looking for a pin bar signal, we need to find other factors of confluence to confirm our entry. We are not going to take any pin bar that we find on our chart. Confluence is an area where most traders would enter the market. So this wouldn't be the confluence. This would be the confluence. Why? Because we have a breakout, a retest, and a continuation. Confluence is where most people are going to be at. That's confluence traders. Confluence happens when many technical indicators generate the same signal. Breakout, retest, continuation. Pin bar, it's the same thing. It's all the same thing no matter how you're looking at it. That's confluence. Okay. Confluence means combination or conjunction. It is a situation in which two or more things join or come together. For example, if we are looking for a pin bar signal, we need to find other factors of confluence to confirm our entry. We are not going to take any pin bar that we find on our chart. Factors. The trend. It is one of the most important factors of confluence. This is the first thing that most successful traders look for on their charts. You can't trade any setup without finding if it is in line with the direction of the market or not. A bearish pin bar in a downtrend is more powerful signal than one in a range bound market because the trend is your friend and you have the pin bar signaling a downtrend. It says a bearish pin bar. Bearish, down, those go together. Support and resistance levels and supply and demand areas. These major levels have a significant importance in the market because all big participants watch these specific areas. So if I take a ball and I throw it against the roof, what's going to happen? It's going to come down. If I take a ball and bounce it on the floor, it's going to come back up. Moving averages. I personally use the 8 and 21 moving average. This is completely optional. This is technical trading tool that I butchered that. I personally use the 8 and 21 moving average. This technical trading tool acts as a dynamic support and resistance. It is a very important factor of confluence in trending markets. Now we have the fib. I use the 61% and the 50% Fibonacci retracement to find the most powerful areas in the market. The 61 and the 50 and the 38, those are key levels. If all of these things match up together, so if the moving average, we have the 100 moving average. If that lines up with a 61.8 and we're in an uptrend and if we have a pin bar to the 61, that's confluence. That's just like all the stars in Orion's belt coming together. Trend lines. Drawing these trend lines, I need coffee. Drawing these lines on your charts gives us an idea about the market direction and helps us find the most important reversal points in the market. When you are analyzing your chart, you are not obligated to find all these levels to determine whether the trade is valid or not. Well, no, you're not obligated to do shit, but it is my job to go find them. If you can find just one or two factors of confluence that come up together with a good pin bar setup, there's quite enough to make a profitable trade. One or two factors of confluence with a good pin bar setup, that's still 3. Yeah. For example, an obvious pin bar signal near support or resistance level in line with the direction of the market. A pin bar signal near support. Okay, so pin bar signal, support or resistance level, reaction, and direction of the market. You see how we're still on 3? Yeah. Okay. EUR, USD, uptrend market. 21 moving average. There's our pin bar setup right in the middle here. Here's our support level, pin bar to the support level, reaction to the 21 moving average. This right here is the golden opportunity to shoot. Okay. In the example above, we have a high probability setup with 4 factors: the trend, the level, the signal, and another signal, the rejection, the formation of the bullish pin bar, the support level. The market is trading up. Okay. See another example. Here's a fib. We have the fib draw from the low to the high. We can see reaction to the 50 nothing to the 60, moving our 21 moving average. It's coming to our support level. So we have a 50% Fibonacci retracement on our pin bar. And then the next candle right after comes to our support level, rejects it. That's two. They give us the thing, and they give us the time frame. That's 2 candles of time to get in. Everything lined up. Moving average, fib, pin bar signal, support and resistance. We have a support level right here. We have our uptrend. We know we're only going up. Cool. The example below shows 4 confluent levels that indicate a powerful trading signal. The first factor is a bullish trend, and the second one is the resistance level that becomes support. The third one is the 21 moving average that acts as a dynamic support level. And the last factor is the pin bar formation near these levels in line with the bullish trend. Let's see if I'm missing anything. Nope. Over here. Nope. Okay. If you adopt this trading concept, you will completely change the way you perceive the market. You will start trading like a sniper by waiting for the best trading setup to come to you instead of trying hard to make these trades happen. Pin bar trades examples. I will give you some trading examples to help you understand how to trade the pin bar candlestick pattern with the trend and how to use confluence concept to confirm your entries. So we have a downtrend market. We have the 21 moving average. We have a pin bar sell signal to our support becoming resistance and a reaction to our Fibonacci. Yes. This is NZD USD in the daily chart. As you can see, the market is trending down, like you said. This is the first information that we gather from this chart. After the breakout of a support level, that becomes resistance and the price retraced back to this level and formed a pin bar candlestick pattern. The formation of the pin bar near the resistance level indicates the retracement move is over and the beginning of the impulsive move is likely to happen. Right here where the pin bar is going down, sell signal. When we put the 21 moving average and the Fibonacci retracement on the chart, we see that the pin bar is rejected from these levels, which indicate that this level is very important and sellers are willing to push the market lower. Here in this example, we have solid reasons to sell the market. The first reason is a downtrend. The second reason is the formation of the pin bar near the resistance level, which indicates that the end of the pullback and the beginning of a new move downward. The third reason is the rejection of the pin bar from the resistance level and from the 21 moving average. And the last reason is the pin bar rejection to the Fibonacci retracement level, which is considered to be one of the most powerful key levels in the market. And we can see that here. So our Fibonacci, our pin bar to our support level, now we come to resistance, out of here. As you can see in the chart above, our analysis was right because it was based on solid reasons to enter the market. This is the method that I want you to learn to be able to trade the market successfully. I'm not saying take these markets, but it's good to have an understanding of how the market moves. So what you've learned is you can understand and see an uptrending market or a downtrending market. You can identify support and resistance levels. You know what these rejection candles are, which is long wicks. If you have a long wick to a key zone that falls in line with your indicators, that's confluence. Multiple things that mean the same thing. The chart above shows 2 important buying opportunities. The market was trending up and the formation of the first pin bar after retracement back to the support level was a high probability entry. What confirms our entry is the rejection from the 21 moving average and the 50% Fibonacci retracement. The same thing happens with the second pin bar that allows us to enter the market again and make more profits. So again, we have our fib tool, our rejection to the downside, our 21 moving average. This is confluence. Again, over here, 61.8, wicked it, didn't close here. So, our moving average coming to this high over here. Same thing over here, coming to this high, didn't break it. Those are things to look at. Trading pin bars and range-bound markets. We can say that the market is ranging when prices don't make any higher or higher low. Don't make any higher high or higher low, and start trading horizontally between a definable level of support and a definable level of resistance. Once I see that the market changes in behavior, I have to change my tactics and adopt a trading strategy that fits this new market condition. To confirm a ranging market, I have to look at least 2 touches of the support level and 2 touches of the resistance level. So 2 to the high, 2 to the bottom. Once I have identified the range, then it becomes very simple to trade it by going long when prices reach the support level and going short when prices approach the resistance level. So when prices come here, we have the market going in between zone to zone, and we just want to take these entries down here based on what happened from before. Simple. As you see price approach the key level of support and resistance, we have the opportunity to buy or sell the market. So there's no trend here. There's no higher, higher, lower, low. It's just going up, coming to this level, coming down. 2 times, 2 times. So the 3rd time we can expect it to do it again. And another thing I'm looking at, look at this pin bar, but it's not a zone. So since it's not a zone, which is above here, and then even without this line, this is the zone. So this to the downside, take out the buyers, and we took all their money. So what this means, do not use one thing to go enter a trade. Resistance level sell zones, support level buy zone, pin bar signal to the zone, pin bar signal to the zone, pin bar signal to the zone. See that? Pin bar signals to the zone. That's not a pin bar, but to the zone. These are not pin bars. These are just wicks. The illustration above shows us 3 trading opportunities. The first one is a pin bar rejected from the support level. You can place a buy order after the pin bar closes, or you wait for the market to touch the 50% of the pin bar range. Your stop loss should be placed above the support level, and your profit target should be placed near the resistance level. So your stop loss should be below here, and your take profit should be somewhere over here. So we can just take it over here, close to the resistance level. The risk reward of this trade is very attractive. The second trading opportunity occurs near the support level. You place a buy order after the close of the pin bar, and your stop loss should be below the support level, and your profit target should be at the resistance level. Same thing over here with these, below the support level, and take profit above. The third setup is an obvious buying opportunity. As you can see, the market was rejected from the support level and formed a pin bar to inform us that buyers are still there. The market is likely to bounce from the support level. Trading from major key support and resistance levels is the easiest way to make money trading range-bound markets. Don't never try to trade any setup if it is not strongly rejected from these areas. The second strategy is about trading in the direction of the breakouts or major key levels and waiting for the prices to retrace back to the breakout point, and then you go long or short your market. Again, a ranging market is this. This is all ranging. There's no higher highs or lower lows. It goes zone to zone. You wait for the breakout, the retest, the pin bar signal, out of here. Second retest, out of here. Okay? Also, left shoulder, head, right shoulder, down. See that? Cool. That was a little gold nugget for everybody there. The figure above illustrates a range-bound market. The price broke out of the support level, retraces back to the point of the breakout. The formation of an obvious pin bar indicates a high probability signal to short the market, sell the market. This is how professional traders trade ranging markets based on this price action signal. How to confirm pin bar signals using technical indicators. Using technical indicators to confirm your entries will increase your probability of the trade being profitable. I'm not telling you that you have to focus on indicators to generate signals, never, because this will never work for you. Okay. But if you can combine your price action strategies with the right indicators, you will be able to filter your signals and trade the best setups. One of the best indicators that I use to confirm my entries when I examine the range-bound market is the Bollinger Band indicator. I don't use that, so I'm going to skip that. The technical trading tools, okay, cool, that's great. For the Bollinger Bands, I personally don't use them. I think they just take up space on my chart. I don't really like to see all this going on. I think the less is more. So I just like to see market structure. So forgive me for not going over the Bollinger Bands. Nothing against them, just not a fan. Okay, the engulfing bar candlestick pattern. The engulfing bar pattern is one of the most powerful and profitable price action patterns. Knowing how to use it properly as an entry signal will tremendously improve your trading profitability. In this section, you will learn how to use the engulfing bar pattern profitably. It doesn't matter if you're a beginner or advanced trader, you are looking, okay, cool. So what is an engulfing bar? This reversal candlestick pattern consists of two opposite colored bodies in which the second body engulfs. The second body engulfs or covers entirely the first one. Second to one, not one to second. Because one to second is Harami, and engulfing is the second to one. Make sense? Okay, a bullish engulfing pattern forms at the end of a downtrend. It provides a clear signal that the buying pressure has overwhelmed the selling pressure. In other words, the buyers are now involved. Again, I always talk about the size of candles. I'll do that in another video one day. In other words, the buyers are now involved. A bearish engulfing pattern occurs at the end of an uptrend. It is the top trend reversal indicator. It shows that the bulls are no more in control of the market, and the price trend is likely to reverse. See illustrations below. So we have the bullish engulfing bar down here, likely to reverse. Bigger than this one, second to one, not first or second. Bearish and that is not a good one, but at the same time, you have the wick to the upside, but the close of the body is bigger. Okay? According to Steve Neeson, the father of the modern candlestick charting, this candle must meet 3 important criteria to be considered as a reversal pattern. Get ready, there's note time. The market is in a clearly definable uptrend or downtrend. Market is clearly uptrending or downtrending. The engulfing candle comprises of 2 candlesticks, and the first body is entirely engulfed by the second one. So the first body is entirely engulfed by the second one. Okay? The second real body is the opposite of the first real body. Okay. How to trade the engulfing bar price action signals. To trade profitably this chart candlestick pattern, you need to respect 3 important elements. The trend. If you look at any chart, you will notice that there are times where the market is moving clearly in one direction and times where it is moving sideways. So a trending market and a ranging market. To be honest, trading the engulfing pattern with the trend is the easiest way to make money in the market. Okay? But an engulfing bar is very easily identifiable in the market. I will say that. You don't need to be highly knowledgeable about technical analysis to determine. You should have a well understanding about the market. I will not say that. Make it stupid simple. If the market is making a series of higher highs and higher lows, that is obviously an uptrend. If it's making series, that's obviously a downtrend. So we have higher highs, higher lows. We understand how a trend is operating. The illustration above shows a clear uptrend. You do not need to use an indicator to determine whether the market is trending or not. No, you should just be able to see that. If you see a low and a higher high, a higher low, a higher high, higher low, that is an uptrend. Vice versa for downtrends. So, 2, the level. When you find a clearly definable uptrend or downtrend, the next step is to identify the most important levels in the market. I mean the most powerful support and resistance. Okay. If price tests a support level and then stop, then this is an indication that buyers are there, and this area is watched by all participants in the market because it represents a great buying opportunity. Conversely, vice versa, if price tests a resistance level and stops in an uptrend, this is a clear signal that the selling strength is in the market. The example below shows how the market participants interact with support and resistance levels. Resistance level, support level, resistance level, support level. These levels take different forms such as trend lines, channels, flags, triangles, and your ability to identify them in a chart will help you find better price levels in the market. In trending markets, when prices pass through resistance levels, that resistance could become support. When resistance becomes support, we can see that here, support is now becoming resistance down. In trending markets, when prices pass through resistance levels, the resistance could become support. See the illustration below to understand how to trade the engulfing bar pattern with support and resistance in a bullish or bearish trend. So resistance is becoming support. Resistance is the roof. You have it over here. It breaks out, retests it as support. Now it's a floor. Engulfing bar over here because it takes out the whole body. And we have a rejection wick to the zone. Now we're taking off. The body completely engulfed. Pin bars, not a whole body. But if the body completely engulfs this candle, it's an engulfing bar. There are other technical tools that can help us find the best levels in the market, such as supply and demand areas, moving averages, and Fibonacci retracement ratios. The signal. The signal here is an engulfing bar pattern. You can apply the same rules when trading the inside bar candlestick pattern. Your ability to identify an engulfing candlestick at a key level in a clear uptrend or downtrend will greatly enhance the probabilities of making a winning trade. See example below. So the engulfing bar, clearly over here, this is a clear one, engulf this body completely. Now, if this was just slightly over, remember, it has to completely engulf the body. So the whole body should be able to fit into the engulfing candle. Okay? Resistance becomes support. You can see a breakout, retest. That is what we want. This is the direct move that we want to catch. You want to catch a breakout, a retest, this is the complete breakout. This is the retest right here. We have our price action signal, which is our engulfing bar. Entries over here. It retested our area down here. Try to hit our stop loss, but our stop loss, as we know, is going to be below the level, which is down here. Excuse me, which is down here. Stop loss never gets hit. You're in profit. Stop loss at break even or above here at the high because of this area, and ride your profits. Trading the engulfing bar with moving averages. Trading the engulfing bar pattern with moving averages provides a very profitable trading strategy. However, the lack of knowledge about the using of moving averages can damage dramatically your trading account. Traders use moving averages in different ways. As a trend following tool to identify the direction of the trend, so they buy the market when prices are above 200 simple moving average, and they sell the market when it is below the 200 simple moving average. Now, simple and exponential, these are types of moving averages that you can put into your chart. To determine whether the market is overbought or oversold, we just watch how prices interact with the moving averages. For example, in an uptrend, if prices move far from the moving averages, this is an indication that the market is overbought. To predict, I'll read that again. To determine whether the market is overbought or oversold, we just watch how prices interact with the moving averages. For example, let me just take that out. That's a good nugget right there. To predict the trend, sorry. To determine whether the market is overbought or oversold, we just watch how prices interact with the moving averages. For example, in an uptrend, if prices move far from the moving averages, this is an indication that the market is overbought. To predict the trend change by using the crossover strategy. If the moving averages crosses over another, it is a signal of a trend reversal. As any trading system, the moving averages have disadvantages. This is why you have to know how to use it successfully under the right market conditions. This trading technical tool doesn't apply to all markets. Never try to use it in a range-bound or untradeable markets. So moving averages are used for trending markets only. Because you will get a lot of false signals and you will definitively blow your trading account. Yes, to the best of my knowledge, using the moving average as a dynamic support and resistance in trading markets in combination with an engulfing bar pattern signal is the perfect way to make money in the market. I wouldn't say perfect, but it's a high probability. The strategy is very simple. We will use the 21 and 8 simple moving averages in the daily and 4-hour time frames. We will define a clear bullish or bearish market, and we simply buy when price pulls back to the moving averages and an engulfing bar pattern forms. So when a market is far away, then the market is from the moving averages, it's overbought is what they're saying. Then you would wait for the price to come back to your moving averages and you get your engulfing bar. This is your buy and you ride that. Now when price is breaking your moving averages, this is the likelihood of a reversal. Conversely, if the moving average is trending down and it shows that the market is in a downtrend, we sell when price retraces to the moving averages. The screenshot below shows how prices interact with the moving average as a dynamic resistance level and how the engulfing bar represented a high probability setup. So if you wanted to play around with the 100 moving average, the 21 moving average, and the 21, the 8, and the 100. The 100 is an exponential, and the 8 and 21 are simple. And the 8 and 21 moving average are used as support and resistance levels. Keep that in mind. They're not just pullback areas. The Candlestick Bible is saying that they're being used as dynamic support and resistance levels. Moving on. How to trade the engulfing bar with the Fibonacci retracement. Okay. Traders use Fibonacci retracement in different ways. However, the most important Fibonacci retracement levels are the 50% and the 61%. Knowing how to use this tool in conjunction with the Japanese candlestick will definitely maximize your profit potential. Okay, so according to chart technicians, the most major moves retrace around 50 and 61%. This knowledge will provide you with the ability to predict with high accuracy the next major move in the trading market. The strategy is very simple. We keep saying this. You define a clear uptrend or downtrend, okay? And then you define major corrective levels by using the fib. I'm going to keep saying fib. If you see an engulfing bar pattern matches up with the 50 or 61% levels, it's a powerful price action trading signal. Okay, so you can see when you have your bar react to your 61% and your 50%, that is what happens. So in the example above, the engulfing bar price action signal matches up with the 50% and the 61% fib. The resistance level that becomes support is another confirmation to take this high probability setup. The trading strategy is very powerful. Stop saying that. Here's another example below that illustrates the power of 50% and 61% fib retracements. What I mean by this trading strategy is very powerful. Listen, any trading method with the right diligence and being used correctly will be profitable. But what we're still seeing is a reaction to a key level, a breakout of a key level, a retest of the key level, and price action, the engulfing bar. Out of here. These are just tools it's like knowing there's 12 inches in a foot, and then you go take a ruler and measure it. The tool just gives you the extra confirmation. Trading the market from 50% and 61% Fibonacci levels means you are trading from the better price levels. As a result, you will put as many probabilities in your favor as possible. And that will allow you to become one of the most popular. Okay, whatever. Trading the engulfing pattern with trend lines. Trend lines give traders an idea about psychology of the market, especially the psychology between buyers and sellers. Moreover, it allows professional traders to determine whether the market is pessimistic or optimistic. This technical trading tool is used in different ways, either as support or resistance by drawing them horizontally rather than vertically, or to identify price and time by drawing trend lines vertically. There is no wrong way in using trend lines. In trending markets, we simply use trend lines to highlight a trend by connecting swing highs and swing lows. So you want to connect all the highs for a downtrend and all the lows for an uptrend. This way, it helps us find high probability entry setups in line with general trend of the market. By connecting extreme highs, we had a trend line that acted as a resistance level and the formation of an engulfing bar. Showed a good selling opportunity. If you used just horizontal support and resistance levels, you will miss out on this profitable trade. Learning about how to draw trend lines is never a bad idea because it's a simplest analytic tool that you can use to analyze financial markets. It works in all markets, whether it's Forex, commodities, futures, or options. Okay? So swing low, and the next one, boom, boom, boom. Breakout, retest, sell was not valid. Keep going. But we have our engulfing bar. See, there's no price action here. No price action. The chart above shows a bullish trend. The trend line acts as a support level, and the price action signal that occurred created a great buying opportunity, which is the engulfing bar, right by the trend line respect. How to trade the engulfing bar in sideways markets. Okay, one of the most difficult markets to predict can be the sideways market and ranging markets. I always recommend traders to focus on trading trendings, but the problem is that to spend more than 70% of their time in ranging markets because it only trends 30%. If you focus just on trending markets, you will probably leave a lot of money on the table. This is the reason why learning how to approach range-bound markets is a must if you want to make decent living trading financial markets. So if you're only trading trends, you're not going to make profit because you're only waiting for 30% of the year for a 30% chance for you to catch a trend. When the market stops making higher highs and lower lows in the case of an uptrend, or lower highs and lower lows in the case of a downtrend, the price starts acting between specific high price and low price. This is a clear signal that the market is ranging and no longer trending. As you can see here, I just call this zone to zone. Zone here, here's support and resistance, right in between. If you're in the middle, leave it alone. As you see the example above, the market is trendless and is trading between horizontal support and resistance. You can apply the same techniques that you'd use in the trending market to trade engulfing bar patterns in a range-bound market. Let me give you an example. When you're driving your car, you don't always drive the same way. If you're driving downtown, you try to drive slowly. You don't know me. What? If you drive, because you know that driving fast can put your life and other life in danger. But when you're driving in a highway, your driving style changes completely because you know that you can drive fast. This is true. So you always try to adapt your driving style to the appropriate situation. You have to do the same thing when you're trading the engulfing bar pattern, because all price action strategies we discussed before will not work in a range-bound market, and you have to use the right techniques that fit the right conditions. So let me use another analogy. It's like having a 60 millimeter bolt and you're going to take a 19 millimeter bolt to put on top of it. You cannot apply the same concept. It's a different market. So if you're in a ranging market, you're going sideways, you cannot apply the same exact trending market. So you're going to wait for a higher high. How are you going to wait for a higher high in a ranging market if it's going zone to zone? You want to wait for it to come to your support and resistance levels. Now, in a trending market, you want to wait for it to pull back, not necessarily come back to your support and resistance levels. You're waiting for price action. Before talking about the right way to trade trendless markets, you have to be selective about trading range-bound markets to protect your trading account, because not all sideways markets are worth trading. You have to know how to differentiate between sideways and choppy markets. So here's a choppy market. How is it a choppy market? I don't see it coming to a high, and I don't see it coming to a low, right? So it's not bouncing off here and coming back down here. That's just once, it's twice down here, or multiple times. It's choppy. It doesn't make sense. The market trades in a crazy way. We can't identify major support levels and resistance levels. You have to stay away from these types of markets. Otherwise, they'll definitely damage your trading account. Trading the engulfing bar candle in a range-bound market is very simple. The first strategy is going to be about trading this price action pattern from a major support and resistance levels like we will see below. See, now it's coming to our area and also respecting down here. We have our engulfing bar. We have our double top. We have our left, our head, and our right shoulder. Another nugget I just dropped for everybody. This is also a triple top. So if you got in here as well. The second strategy is to trade the breakout of the range or to wait for the pullback. See the illustration below. Now here's an even bigger head and shoulder. So we have our resistance level, our engulfing bar, and our false breakout. We have our left shoulder, our head, and our right shoulder. We have a left shoulder, a head, a right shoulder. We have a left shoulder, a head, a right shoulder. We have a left shoulder, a head, a right shoulder. All of this creates one big ass left shoulder, our head, and our right shoulder to hell. The third strategy is to trade the false breakout of major support or resistance level. False breakouts are one of the most powerful price action strategies. It occurs in all types of markets, and if you know how to use it in combination with the engulfing bar pattern and a major support level or resistance, you will make money in the market because you will buy intelligently the bottoms and sell the tops. Like I was saying, you want to get in on the bottoms or the tops. And you can have pretty much an exact stop loss because your stop loss will be above. Trading the engulfing bar with supply and demand zones. Supply and demand areas are more powerful than support and resistance. It is the place where banks and institutions are buying and selling the market. If you can identify these turning points, you will make a difference in your trading. To trade the engulfing bar pattern successfully with supply and demand zones, you have to be able to identify quality supply and demand areas on your chart. According to my experience, there are 3 factors that define quality supply and demand areas. So this is not support and resistance. This is note-taking time again. So write down supply and demand areas, and here we go. Number 1, the strength of a move. The strength of the move. Pay more attention to the way the price leaves the zone. If the market leaves the area quickly, this is an indication that the banks and institutions are there. So if it's a big strength, if there's a lot of strength, if it's big boys and big girls, then the banks and the institutions are there. Those are the hedge funds. Those are the bankers. That's all the smart money. Good profit zone. You have to make sure that the levels provide a good risk to reward. So obviously you want to make sure that the trade is worth taking. Bigger time frames. The daily and the 4-hour supply and demand areas are the most powerful in zones in the market. The chart below shows a quality supply area. As you can see, the move was very strong and indicates that the banks and institutions were there. The formation of an engulfing bar was a clear signal that the bears are still willing to sell from the same price level. So we have the strong move. They left immediately. Here's our supply area. Here we go again. Another example. We have our strong move to the downside. We have our left inverted, our head for the buy, our take profit at the zone, supply area, sell. Now, was this a clear area for a buy? No, because there's nothing to the left. So we leave that alone. But for the sell, we have our strong move to the downside. Let me zoom in here. What do we have? Any price action? No, I don't see any price action. So here's our strong move. Here's our pin bar. Is that our key zone? Yes. Is it a pin bar to our area? Yes. Do we know that this is an area to take out this lower high? This is having a brain part. This is a lower high. This area. This is our previous what? This is our supply area. It's our low. Support becomes resistance. So this is our support. We're testing as resistance, pin bar, supply area, entry, down. 1, 2, 3. I think that this is not complicated to identify these zones because they are characterized by strong moves. The secret behind supply and demand areas is that the big players put their pending orders out there. Pending orders are for lazy people, always market execution. When the market approaches these zones, we see crazy move from these levels. So let's mark all that up. Put that, put there, put that, put that there. If you can combine trading supply and demand areas with the engulfing bar price action signal, you will increase your chances to make money as a trader. Sure. Money management trading rules. Again, I'm not being sarcastic because of what they're saying. I just don't like when people say that this will increase your trading, that will increase your trading. Whatever you're able to absorb and adapt and implement will help you. Simple. So far, you have learned how to identify high probability setups in the market if money management trading rules. Price action signals with low risk reward ratios should be ignored. Price action signals with low risk, high risk reward. We don't want low risk reward. Once the criteria of a high probability setup are in place, there is no more analysis to be made. Just make sure your trade has a potential 2-to-1 risk to reward ratio. I mean, the amount of money you will win has to be twice the amount of money that you will risk. Does that make sense? So, demand area. I have to have a low stop loss to make a shit ton of pips. That's how this should go. Okay. Let me see. Oh yeah, this is case. The man taking 10 trades. Okay. Entry and exit. Don't try to be smarter than the rest of the traders. Keep it simple. You know what you're looking for. When to identify and go from okay. Stop loss. You see the supply area. This is what we're going to be looking for in the zooms now. When you set a protective stop and your target, don't never look back and let the market tell you if you are in the wrong or right. This will help you trade successfully. I see somebody emotions. Yep. If the market goes against you, you will not feel good. It's normal. I like this. It's normal. Losing money can be emotionally painful. It is in our human nature. Nobody wants to lose, especially when it is about money. In the trading environment, you have to think differently. Accept the fact that losing is a part of the game. Losing is a big part of the fucking game. This is why it's a risk and reward game. This is a grown folks video game. It's all about getting points. It's all about winning, but at the same time, you have to understand that you will lose. It's like getting through a story mode in the video game. Even every time you keep losing against the big boss, you're going to give up. Some people do. Some people sit there until they beat the boss, and it's the biggest triumph in the freaking world. It's like Rocky Balboa going up to the fucking steps. Studies have shown that the successful traders don't risk more than 2% of their equity. I'm not going to comment on percentage or how much you should risk. You should understand what you should risk to reward. You should understand that you should risk very minimal in order to have a great reward. You should understand that you want to live to trade another day. You should understand that you're not going to get rich overnight. And you should also understand that you have to be consistent, diligent, and practice discipline. Because if you don't practice any of those, if you don't put in the work, you're not going to make money. I think I can leave on this note. I want to give everybody a good understanding of the Candlestick Bible, not just reading it, also reading it with a little bit of trading perspective. I have a trading perspective because I've been trading for quite some time. It is pretty boring to seeing the same words over and over. I hope you were able to understand a little bit more in depth about trading. Try to find these pictures in the market. Try to understand where would be a good place for me to enter. Wait for your price action. Identify your trend. Follow your directional biases from your higher time frame, your top-down analysis to lower time frames. Wait for your price action. Get in. Stop loss above the high or low. Keep it simple. No need to complicate it. If you can do that, you will be profitable. And after seeing this, the last thing I will leave you on is 100% of traders make money in Forex. 1% are successful. The difference is greed. People don't know when to take their money.